Microsoft confirms more job cuts on top of 10,000 layoffs already announced in January, and there's turbulence in the tech market. But my guest today is confident, both in overall corporate performance and Fed policy that signal a continuing encouraging market. I'm Merrill Brown. Our guest today is Anastasia Amoroso, Managing Director and Chief Investment Strategist at iCapital. Anastasia, why the optimism?
Well, because all the forces that really weighted on the stock market in 2022, they have reversed so far in 2023, and I think that continues. And what I mean by that is, first of all, inflation. Inflation is definitely cooling, whether it's shelter inflation that's coming down, whether it's food or fuel prices, whether it's good inflation, all of that is definitely starting to come down, and wages are cooling too. So that's the first thing. The second thing is, as a function of inflation, the Fed seems to be pausing. And so we went from, having 4 consecutive meetings of 75 basis points worth of rate hikes, to now maybe we get once a quarter. And that's a materially better environment for stocks. And then the third one, Merrill, is the economy. It might be cooling, it might be slowing, but it's not recessionary. It's not falling apart. And when you put all of that together, that means that valuations can be supportive for stocks, and so can earnings. And that means that there could be more stock upside to come.
The S&P has had a good year so far, and you think there's more good news ahead and a gain of maybe as much as 10% to the 4,800 range. Why?
Yeah, well, first of all, that's the consensus view, but I do subscribe to that because it's math. And when you think about this non-recessionary environment, that probably does support a multiple of 18 to 19 times where we are today. And I know some people will push back on that. That's really high, and 15 or 16 times maybe is where we should be looking for. But look, so much of the S&P now is in tech. And the tech margin is 22% versus the S&P margin that's 12%. So I think when you account for that, that's why I'm actually okay with the current level of valuations for this non-recessionary economy. So that's one piece of it, and why I still think that we can get to 4,800. But the other one is earnings. Earnings may be flat for this year, but pretty soon consensus is going to start to look at 2024 earnings. And for that year, we're looking at $246 in terms of S&P 500 earnings. So you take the multiple, you apply that to the 246, which by the way has been de-risked, and that's what gets you to a target of 4,800. Do we get there by year end? I don't know, but I think in the next 12 months, I think that's your potential upside.
And what's the risk?
Look, the risk is we might have been too quick to count out the recession. The risk is that the Fed actually wants to engineer more of a slowdown in a truly recessionary scenario, and we may end up with inflation that's sort of stuck around this 3% level. And so if the Fed continues to say we need to do more and truly causes a recession by hiking rates more to really get to that 2%, I think that's the biggest risk, which certainly is now being priced into the markets, but I don't know that we need to price that risk today.
Next, Anastasia Amoroso on why much of the market will catch up with the tech sector.